Why is gold pumping right now? Because the US has cracked and started printing money again. At least that's what everyone is going to be saying over the next few days, and it's sort of true. I'll explain the sort of in a second, but first let's talk about why gold is pumping right now. Well, this week, the 30-year Treasury yield hit its highest level since 2007. In plain English, the world just told the American government that nobody wants to lend it money anymore because they don't trust it. And the US Treasury, the department that does all of the borrowing, they kind of cracked. They doubled the size of something that they call the liquidity support buyback operation. They name it those four boring words because it's specially designed to stop you from listening. So let me rename it with 5 words. Interest rates down, gold up. That's it. Interest rates down, gold up. Are you listening now? Well, those 5 words are why gold ripped over 3% today. If that's all you need, stop watching now. If you want to understand exactly what's happening and what it means for your gold, let's crack into it. Right, so let's start with what the US Treasury actually is, because they are the ones that just folded and started what many people are going to call QE. If you don't know what QE is, it stands for quantitative easing, and it's when a country prints money. Now, in my opinion, this is not the same as QE, what's happening right now. It is actually a fair bit worse, to be honest, but the effect on gold is just as good. So let me explain how this works. So when the US government spends more than it collects in tax, it needs to borrow money to make up that shortfall. Where does it borrow money from? Well, it's not from like a magic pot. It borrows from investors, pension funds, foreign countries, banks, and a lot of time the money comes from you. You might not know it, but it does. So you hand over cash, they hand you a piece of paper. That paper is a certificate called a treasury or a bond. And it says that they'll pay you interest every year and give you back the money at the end. The interest rate on that paper is called the yield. The government does not set the yield, the lender does. Whoever's going to lend the money, they set the yield. So if the lenders are relaxed, then they're all good. They take 3% per year to lend to the government for 30 years. If they are nervous about getting paid back in money that's actually worth anything because of inflation, they demand more. They demand 4%, 5%, or even more than that. So the 30-year yield isn't really an interest rate, it's a confidence score on the United States, and it gets published in public where everyone can see it daily. And this week, that score hit 5.33%. That is the worst reading since 2007. Now think about what that means. The US is the most powerful government on the planet, and the market is charging it more to borrow than at any point since before the financial crisis. Why? Well, bloody take your pick. I mean, the US has $40 trillion of debt. Inflation is still running at about 3.3% and refusing to go away. And a war that nobody can end has just started in Iran. Oh, and not to mention, there's a brand new chairman of the Federal Reserve, America's central bank, a bloke called Kevin Walsh that nobody has fully figured out yet. Whatever the reason, buyers said, we aren't lending you shit. And this is the single most dangerous thing that can happen to a government carrying $40 trillion of debt. Because if you can't borrow, you can't function. Remember how debt works, by the way. If you can't pay it back, you have to refinance. Let's say I borrow $1,000 off of my mate Bob. Bob wants his money back. I haven't got it. So I have to borrow off my mate Tom to pay Bob back. But if Tom's not going to lend me money, well, Bob is going to break my legs, right? Probably not, but my friends aren't that bad. But anyway, no one wants to lend the US money. And when no one wants to lend you money, the interest rate goes up until someone finds the interest rate attractive enough to actually lend you money. But this is bad for the US, and it's bad for gold. Remember those 5 words we talked about? Remember our 5 words? Interest rates down, gold up? Well, the opposite is also true. Interest rates up, gold down. So anyway, the US Treasury, those are the guys that borrow money, they want interest rates to come down. That way they can keep borrowing at a lower rate. So they announced that they are doubling their buyback operations from $2 billion ago to at least $4 billion ago, running from the 9th of September through to the 4th of November. I know that sounds confusing, but let me explain. A buyback just means that they are buying back their own bonds off of investors. They basically call the banks and say, we'll buy your bonds for cash. Banks like cash, so they say, yeah, okay, we'll take that deal. But hang on, where are they getting the cash from? I mean, nobody wants to lend them money. How can they all of a sudden afford to buy bonds? That's a good question. They borrow it. They take on new debt to pay off old debt. And to see why that helps them, you need to know there are 2 types of government debt. Bonds are the long ones. They run up to 30 years, and that's where the rate gets locked in for decades. Treasury bills are the short-term ones. They're called the short ones, or the short end. They borrow for a few weeks to a year, and they have to pay it back to the lender pretty much right away. So the problem for the US right now is that nobody wants to buy the long ones. Why? Because when you lend for 30 years, you're guessing what inflation does between now and 2056. Nobody wants to make that guess right now. It's a bit too risky. So they charge a fortune for that risk. That's why bonds have gone up to 5.3%. So America desperately needs that 5.3% number to come down, and come down a lot. How does it bring it down? It issues treasury bills, which, remember, are short-term debt. So essentially it borrows money over the short term to pay back money over the long term. So people are more willing to lend the US money short term because it's a lot less risk. It's easy to predict where interest rates are going to be 3 months from now versus, 30 years from now. So that's what's happening right now. America makes its 5.3% problem disappear today, and in exchange, it has to go back to the market every few months and reborrow, refinance, because the debt is short term. So remember Bob and Tom that we talked about earlier? That's all this is. Refinancing, just with a lot more zeros, which works fine right up until the short-term lenders get nervous as well. They're not nervous right now, but they might be soon. Then a whole lot of repricing happens at once with nowhere to lock it in, right? So why is this good for gold? We'll talk about that in a minute, but first we need to talk about money printing. So is what's happening right now money printing? Not exactly, but it's close. See, whenever something like this happens, people all over YouTube say that the US is printing money again. And I get it. It's because it's easier than explaining all this complex crap that I've just been through. But it's not really the same as printing it again. That being said, the effects are kind of the same in the end. Printing money means that the Federal Reserve creates brand new dollars that didn't exist before and buys bonds with them. New money out of nothing. Now, the Treasury can't do that on its own. They can't just create money out of nothing. In reality, every dollar that the Treasury spends on a buyback is a dollar that it borrowed from somewhere else first. But the effect is kind of the same. See, the reason QE, or money printing, pushes long-term rates down isn't the money itself. It's that the central bank takes 30-year bonds off of the market, so there are fewer of them left for everyone else to hold. Fewer bonds means that the yield on those bonds goes down, meaning that that 5.3% number they are desperately wanting to go down starts falling. The Treasury just did exactly that. They took 30-year bonds off the market. Now there's fewer left and yields fell. They already are down from 5.33% this morning to about 5.2%. That is just today. So when QE happens, new money is being printed to buy bonds. What's happening today is more like new money is being borrowed to buy bonds. But either way, bond rates fall just like they did today. And look, I don't care much what we call it. What matters is the direction. The direction is a government that has decided it cannot live with that 5% long-term rate anymore and is now doing something about it. And by the way, another reason why the market is reacting like this, like it is right now, is because this could turn into QE. They've shown that they are desperate enough to do this in order to bring rates down. If this doesn't work, they might need to ramp things up, and then this turns into QE. But why is this good for gold? That's the big question, because of what the Treasury just told us about itself. They didn't announce this at a press conference. They put it out in a document the day after the worst bond market reading since 2007. It signals that they are desperate, they are cracking. And the program conveniently ends on the 4th of November, which is also interesting. The midterm elections on the 3rd of November. Is that a coincidence? I don't really think so. So why would they care about that date? Because the long end of the bond market sets the cost of borrowing for everyone else, mortgages especially. American mortgage rates are set around 6.7% right now, which is pretty bad. And they follow these long-term yields, that 5.33% number. So if the 30-year keeps climbing, mortgages climb along with it, and millions of voters feel that in the month before they vote, which isn't great for the government right now. It isn't great for Trump. So the government is scared of that 5.3% number. Trump is scared of it. And once you know that they are scared of that number, you know how this ends. They just showed their hand. A government that has moved on to short-term borrowing needs the short-term rate to be low, desperately, because every single year it has to go back and borrow the whole lot again, which means the pressure on the Fed to cut is now permanent. Whatever Kevin Walsh says about hiking rates, the debt decides that this is not going to happen anymore. And that's Kevin Walsh's big problem right now. And when they cut into inflation, because inflation hasn't gone away, you get the thing that I've been banging on about for years. You get interest rates that are lower than inflation, and that is really bad, but it's really good for gold, by the way. That's called your real rate. So the interest rate you earn minus inflation. So right now you get about 3.6% on short-term government debt, the Treasury bills that we've been talking about, right? Meanwhile, inflation is sat at about 3.3%. So you're making about 0.3%. It's positive. It's basically nothing, but it's still positive. Now watch what happens when they cut. Drop that 3.6% down to 2.5% if they cut interest rates, while inflation is still sat at 3.3%. And your real rate goes negative. At that point, you're losing value every single year just by holding dollars. And there is nowhere to hide from it because it's money. It's the money itself doing that. That's the environment gold exists for. Everyone thinks gold is a war trade or a crash trade, and it really isn't. It's a debasement trade. So gold works when the people who issue the currency need that currency to be worth less, which is kind of happening right now, because gold is the only thing that they cannot print. And that's what's happening today. Gold is up over 3% in a day. Silver is up like 4%. They keep moving up, so it might be higher by the time you watch this. And I said at the start of this video that I could summarize it down into 5 words. Interest rate down, gold up. That's it. So that's what's happening today. So what am I actually doing about this? Honestly, I'm doing nothing. I'm just kind of enjoying it. I hold about 30% of everything I've got. Well, not everything I got. My portfolio. I hold 30% of my portfolio in metals, gold and silver mostly, bought between around about 2013 and 2020. My average buy price for gold is around about $1,400 from memory. And I'm not selling any of it. That's it. Honestly, I was expecting gold to come down a little bit, but that's the thing with markets and why they always surprise you. No one expected the US government to crack all of a sudden. No one expected them to ramp up short-term borrowing to buy back long-term debt at this kind of scale. This is a crazy scenario and, it doesn't happen often, but it just happened. So what am I doing about it? I'm just going to enjoy the ride. This doesn't mean that gold is going up, 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 up forever. This could easily be a short-term reaction and it could retrace, but it is an overall good signal for gold holders. I hope that makes sense. If you have any questions, ask them in the comments below. I'll try my best to answer every single person. And yes, I did push out a video earlier today, but then I took it down because I saw gold blow up. So I wanted to cover this instead. This is way more important than what I was going to say earlier today. I'll see you in the next one.